Okay, so maybe we can start right away. What do you think? The first exercise is really simple. Again, in this afternoon, we are going to cover the exercises and problems related to calculated earning per shares, basic and diluted earning per shares, as well as situations when we have bonus and rights issues. So we first do the basic problem, the problem 1 in tutorial 3. Something else to mention, by the end of this afternoon, I have prepared only one example about the segment reporting. One of you asked me, what shall we do to handle the situation when we do not identify enough reportable segment to comply with the 75% threshold. So by the end of the afternoon session today, we are going to have an example about the segments. But for the moment, we can start with the problems regarding the earnings per share. Remember that basically earning per share is the division or the ratio between the earnings that is attributable or available to the common shareholders divided with the number of shares, where the number of shares should be a weighted average that reflects the amount of time that each one of the classes of shares has been in issue or outstanding during the year. So we have the case of this company that starts with 5 million euro ordinary shares. Each of them has a par value of 1 euro. This is available in issue at 1st of May 2008. Then on 30th of September, the company issued 2 million ordinary shares at par value. So the par value is still 1 euro. Now remember that from 1st of May to 30th of September, it means that there are 5 months in there. For 5 months, we have 5 million shares in issue. And for the 7 months left for the accounting year, there are 7 million shares in issue. We have the profit before taxes for this company. It is 650,000 euro. And we also have the tax expenditure. For the same year, we have to calculate basic earnings per share. Now, I will use the second sheet for representing the solution. Okay, first of all, let's remember together what is the formula to calculate the basic earnings per share. So basically what we do here is that we divide earnings available to common shareholders to the weighted average number of shares. I will use a simplified mini table over here to show the calculations that are needed for the basic earning per share. So we have the first thing we want to know is the earnings available to the common shareholders. Again, usually the earnings available to common shareholder is a net profit minus the preferred dividends if we have them. So first of all, we need to calculate the net profit. The amount that we actually have for the moment is profit before taxes less tax expenses to calculate profit after taxes. Now remember that tax expenses, usually we have recognized by this abbreviation over here, income tax expense. So that's why I'm putting over there. So profit after taxes, and if we have, in this case we don't, but I'm just putting that there for a complex representation. If we have preferred dividends, that would be subtracted as well. So let's prefer dividend because this is something that does not belong to the common shareholders. And therefore we have earnings available to common shareholders. Let's see how we can do this in the case of our example, our information. Profit before taxes for this company is $650,000. So let's put it in here. Then we have the tax expenditure that we have to deduct. The tax expenses for the year are $210,000. That means that the profit after taxes is the is the division between two, is the difference, sorry, is the difference between both figures that we have here. I apologize for that. Okay. So this is the amount of profit after taxes. In this case, we do not have any preferred dividend, so that means that the earnings available to common shareholders are the same as profit after taxes. With this, we have recognized, we have calculated the first line needed to be able to calculate basic earnings per share. So earnings available to common shareholders. The second item that I need is the weighted average number of shares. So here we have a weighted average number of shares. And if you remember, we can use two ways to calculate the weighted average number of shares. Now, remember that we start with 5 million, and after 5 months, we issue 2 million other shares. That means that basically I can represent the calculation like this. We can start with 5 million shares. They have been in issue for 5 months out of 12 months of the year. Plus, we have then, after the date, 7 million shares which have been in issue for 7 months out of 12. So this is a way to represent the calculations of the number of shares, okay, like this. So we can take into account the period and of time that they have been outstanding, which is what the calculations of weighted average number of shares actually requires. So if we make the calculations over here, it will be like 6,166,6070. Okay, sorry about that. So 6,166,667. This is a way how to calculate for the number of shares. The other way that it's the same thing, but sometimes the others may find more useful, is that we can assume that we have the 5 million shares from the beginning until the end of the year, so they are available for the whole year, multiplied by 12 and divided by 12, plus the rest of 2 million shares we have been issuing or outstanding only for 7 months. So basically it would be, if we would make right here the calculation using the Excel formula, 5 million plus 2 million, which is multiplied by 7 and divided by 12. And though this is the amount, so this is the amount of shares, again, if we use the formula, the Excel formula. So basically it is the same as before. Any question related to anything that we calculated so far? I'm just deleting this amount because it's the same thing here. You have the applied formula related to the second way of calculating the weighted average number of shares. So we arrived at the second figure needed to calculate basic earnings per share, and right now we need only to divide them. Earnings divided by the number of shares, and right here expressed in a currency value. That means that 7 cents basic earnings per share will be 7 cents per share. This is the amount of the basic earnings per share calculated according to the requirements of IAS 33. Any question related to this first exercise? This is the first problem that we covered today. Any questions so far? I think this is the easiest, and I'm almost sure that most of you that tried to solve this exercise did not have any problem, I hope. So it was easy. I'm jumping in the next problem. There were, if I'm not wrong, 6 or 7 out there. So we will go through all of them today. In case you have any other question, in the meantime, you are free to ask. So problem 1 is solved. Now we can have a look at problem 2 of the tutorial 3. I'm apologizing if I can switch off the camera because of the bad internet connection I'm having today. So I hope you don't mind. This way we can better focus on the solution of the exercise. So again, I've put in an Excel file all the data, and I also have prepared another sheet for showing the solution of the exercise. We have the example of a company that had 10 million ordinary shares in issue at 1st of January. Then on 1st of August, that means like after 6 months, the company issued 7 months, sorry, the company issued 2 million ordinary share at a premium. During the year, the company had also issued 2 million euro, 7% convertible bonds redeemable in 2009. The terms of this instrument allow for the bondholder to convert every 100 euro of bonds to 50 shares of 0.5 euro. AB profit available to ordinary shareholders was 3 million euro for the year 2007, and the tax rate is 30%. We are required to calculate the basic earnings per share and diluted earnings per share for 2007. So I will start right away with calculating the basic earnings per share using the same approach as before. So first of all, I will try to determine what are the amount of earnings available to common shareholders. So again, let's have a look at the information that we have here, and we see that the company has provided very detailed information. It is readily available over here. We do not need to perform any calculation like before. The profit available to ordinary shareholders is readily provided in the amount of $3 million over here. Okay, so we just put the amount. Okay, 1 0 more. So the earnings is 3 million. Next, we need to calculate the weighted average number of shares, right? So the next step is to calculate these shares. Now remember that we start with 10 million, and after 7 months, we issue 2 million shares. So 10 million multiplied by 7 to 12 months that are in issue. And then we have 12 million after issuing 2 million new ordinary share. These 12 millions are in issue for 5 months out of 12. So let's make the calculations over here to have it more easy to perform everything later. Multiplied by 7 divided by 12, and that would be 12,000 multiplied by 5 divided by 12. Okay, so this is the total number of shares if we combine them together. The weighted average number of shares that takes into account not only different number of shares in the beginning and at the end of the year, but also the proper time when they have been in issue is 10,833,333. So the basic earnings per share that we can calculate over here is simply the ratio between the earnings and the weighted average number of shares, and we right here we can receive this information. So it is 27.7 cents. I will write that there, 27.7 cents per share. So this is the basic earning per share. We proceed with the second step. This is basic earning per share, but the second step is to calculate the diluted earnings per share, right? So we start again with earnings with the previous figure that we stated. That was the earnings figure. The earnings available to common shareholder is 3 million, as we stated that, but we have to take into account the interest savings. Interest savings post taxes. Now, what does that mean? In case we assume the conversion of these convertible bonds over here In case you assume that they are going to be converted into shares of ordinary shares, remember that this 7% of interest will be saved, will be not paid anymore. That means that the profit available to ordinary shareholders will need to be increased, will need to be added back the amount of interest that will not represent an expenditure anymore. And as we discussed beforehand, this is an interest expense. That means that it has been deducted before taxes, and in order to add it back or to reverse its effect, now that we add it back, we have to apply the after-tax solution or after-tax effect. That means that if we come here at the interest savings post-taxes, that would be interest expenses multiplied by 1 less percentage of taxes over here. The interest expenses are 7% and the bonds are 2 million. That means that we calculate the interest expenses with 2 million multiplied by the interest rate, which is 7%, then multiplied by 1 less percentage of taxes. If I'm not wrong, it was 30% over there, but we can double check. So again, this is how we calculate the interest expenditure after taxes. Yes, the tax rate is 30% and the interest rate on the bonds is 7%. So let's go here. Let's calculate the interest savings, that is equal to 2 million multiplied by 7% multiplied by 1 less the percentage of taxes, that is 70%. So this is the effect. Sorry about that. So this is the post-taxes interest savings due to the conversion of convertible loans to the ordinary shares. That means that the adjusted earnings that we will need to take into account for the calculation of the diluted earnings per share is $3,098,000. Any questions so far? So again, in the diluted earnings per share, we start with the same amount of earnings and we apply the needed adjustment. And the adjustments here are the interest savings, post taxes. We add them back. Sorry about that. So we need to add back the interest savings post taxes. That means interest expenses multiplied by 1 less percentage of taxes, and we find the amount to be 98,000 euro. Again, I need to calculate the weighted average number of shares. Weighted average number of shares. Actually, nothing has changed related to the weighted average number of shares. So the diluted earnings per share will take into consideration the previous amount that we have here, sorry. So the beginning figure that we start our calculation is 10 million shares, 833 and 333. But then we have to add new shares from conversion of bonds, right? So how to calculate for that? You see the terms of conversion over here helps to make the calculation appropriate. The term of this instrument allow the bondholder to convert every 100 euro bonds, remember we have 2 million, to 50 shares of the ordinary shares, what it is written over there. So that means that if we start with 2 million euro and then we divide that by 100, and if we multiply that by 50 shares, that will give us the number of the new shares that we have from this conversion. So we start with 2 million euro. Each 100 euro of these bonds will be converted into 50 shares. That means that the new number of shares will be 1 million. What is the total number of adjusted shares after the conversion? 11 million. 833,333. That means that the diluted earnings per share will be the division, the ratio between the adjusted amount of earnings to the adjusted amount of the weighted average number of shares. And we have over here a diluted earnings per share in this amount, which is 26.2 cents. Any questions so far? 26.2 cents per share. So again, maybe this mini table, I'm calling that like this, will be helpful to guide you through the steps of how to calculate basic earnings per share and also the diluted earnings per share. Any question before we continue? Okay, do we need to stress anything over here? I think that's clear, diluted and basic earnings per share. And I also hope that if you try to solve these exercises before the class, you have the same results. I really hope that. So maybe we can continue with the other exercise, the next problem. I'm just preparing the Excel file, right? When we will have the solution. Okay. This is the third problem. I inserted the information over here to readily read it. We have a company. Actually, if I'm not wrong, this is an exercise that was included in the last year exam, one of the exams. So if we can go through that, this means that you are partially ready for the final exam till this moment, let's say. We have a company that has reported net income. Be careful, this is the net income. It is not the income or earnings available to common shareholders, right? This is what we have to keep in mind constantly. Then we have the company that is having a weighted average of 690,000 shares of common stock outstanding. So till now we have common stock. In addition, the company has only one potentially dilutive security, and that is convertible bonds. Okay, this means that we do not have any preferred shares. And right now we can say that if we do not have any preferred shares, this net income reported here is the same amount as the earnings available to common shareholders, because earnings available to common shareholders are net income less preferred dividend. But if I don't have preferred dividend, then it is the net income. Okay, so let's keep this in mind. In addition, the company, we read that they are convertible into a total of 10,000 shares. Assuming a tax rate of 30%, calculate the company basic and diluted earnings per share. Now, some clarification before we continue. Regarding the solution, remember that if the debt securities are converted, those would no longer be outstanding. Instead, we would have an additional 10,000 shares of common stock outstanding or in issue circulating in the market. And also, the other side of the story is that if the debt has been converted, the company would not have to pay interest of 3,000 on the convertible debt. How do we calculate 3,000? That is because we have a debt of 6% on 50,000 par value. 50,000 multiplied by 6% gives us the 3,000 amount over here. That means that net income available to common shareholders would have increased by $2,010. And the calculations are shown like the interest expenditure. To reflect the post-tax effect, we multiply that by 1 minus the tax rate. Okay? So the exhibit that we are going to show right now is the solution over here. Again, I will follow the same way of calculating first the basic earnings per share and then the diluted earnings per share. We start with earnings available to the common shareholders. Here are the same as net income because we explained there are no preferred shares in the structure of the equity of the company. So we start with earnings, divide them with weighted average number of shares, and that is also readily available. And then we have the basic earnings per share that is required as a first step. So let's insert all the information over here. Earnings is, as we can see in the data, earnings is 750,000. The weighted average number of shares is provided over there. It's 690,000. 690,000. So this means that the earnings per share will be calculated 1, and I'm also inserting that there, $1.09 per share. So this is how easily we can calculate the first thing, that is basic earnings per share. Now let's continue with the second element required in this problem. The first one was the basic and the second one the diluted earnings per share. Now again we will follow the same approach. We start with the earnings and then we adjust this by adding plus after-tax effect of interest. After-tax effect of interest rate. So let's make the calculations a little bit easier by inserting the secondary data in a internal column, if I may say that. So the earnings where we start the calculation are 650,000, and the same are the ones that we start over here, the calculations, plus tax effect, after tax effect of interest rate. That is actually calculated, but I'm for reference reasons, I'm including them there. So we have a 50,000 convertible debt multiplied by 6%, which is the interest, which is then multiplied by 1 less the percentage of taxes, which is 30% in this case. And if we properly do the calculations, 50,000 debt multiplied by 6% and then multiplied by 70%, this is 2,100, representing the adjustments that need to be done. That gives us the adjusted earnings to be used in calculation of diluted earnings per share. So this is something that we need to adjust before we continue with the calculation of diluted earnings per share. So this is the new amount of earnings that I need to take into consideration for calculating the new ratio. Now we continue with the second component, and that is the number of shares. Of course, initially the number of shares is the first one before adjustments are made, but then I have to take into consideration new shares plus new shares out of conversion. And in this moment of the exercise, you always have to read carefully what the problem or what the exercise tells us about the terms of conversion. For example, over here we are told that all this debt, dilutive security, $50,000 is convertible into a total of 10,000 new shares. So this is the amount of new shares that we have to include over here. And the adjusted number of shares that we should take into account for calculating the diluted earnings per share, therefore, is 700,000 shares. That means that the diluted earnings per share figure that we are required to calculate is the division, the ratio between adjusted earnings and adjusted number of shares, that represents a diluted earning per share like 1.07 dollar per share. Probably you have noticed something in our problems or in our exercises. You have noticed that almost always the diluted earnings per share is lower than a basic earning per share. That is because we usually take into account only the dilutive securities, those that are likely to decrease the value of the earnings per share. Usually, what IAS 33 mentioned is that if there are securities that are not dilutive but anti-dilutive, probably they will not be taken into consideration here. And that explains why almost always, diluted earnings per share is lower, even by this small amount that we have here, is lower than the basic earnings per share. Okay, so this is the problem 3. Again, with the first problems we covered, I hope, extensively, the case of calculating basic and diluted earnings per share. Any questions so far? In case you need to ask something, you are free to do that. In the meantime, I'm preparing for solving problem 4. So I hope that you can see the Excel file right now. It has the same information that we have been sharing through the tutorial. So in this case, we have again 2 requirements. There is this company that have this information related to the current year. We have the net income for the year, 6 million. And you see here, it is very simple to see that we have deducted the preferred stock dividend, that is income available to common stockholders, 5,900,000. And then we have some extraordinary item. That means that we have net income available to common stockholders. Compute the weighted average number of shares. I'm not sure if I have taken every piece of information. Let me check with the tutorial. Am I lacking any piece of information over here? I'm checking problem 4 in the tutorial. Maybe I did not took all the information there. Okay, so problem 4 has lack of data. Okay, so net income, common shares. Okay. Did you notice this? I'm just inserting that information over here. So in the tutorial, problem 4, we are told that common shares outstanding on January 1st are 3 million shares. This is the beginning of the current year. And then we have another information. Stock issued on October 1st, that means like 9 months after the start of the year, we are issuing 400,000 new shares. Okay, so this is the complete information again. Again, we have common shares in the beginning of the period, 3 million, and then we have 400,000 issued in October 1st. We are required to calculate the weighted average number of shares and then to calculate the basic earning per share for income available to stockholders before and after extraordinary items. I would just like to remind you of something. One of the requirements of IAS 33 is that in case we have discontinued operations, or in case we have some not abnormal activity or extraordinary items like this over there, the company should calculate and disclose the basic earnings per share relating to each of these activities. So the basic earnings per share, that is before taking into account the extraordinary item, that is based in net income available to common shareholders, and then the income before taking into account the extraordinary items. So again, this is a requirement of IAS 33 to declare and report basic earnings per share before and after discontinued operations, abnormal activity, or extraordinary items, as we may find here. So let's start with calculating the basic earnings per share by following the same approach that we explained so far. So we start with net income for the year, as this is the information that we are given, and then we deduct the preferred dividend. Therefore, we can calculate the earnings attributable to common shareholders. This is something that already is given, I agree, but by calculating together, we can learn more. Again, net income for the year is equal to 6 million. The preferred dividend is equal to 100,000, and the earnings available to common shareholders are 5,900,000. We have to take into account extraordinary items just for the sake of complying with the IAS 33. Okay, so the extraordinary items, that means some extraordinary, not normal expenses in this case. I am clarifying that a bit further. Extraordinary items in this case means expenditure of a not normal nature, expenditure of an abnormal origin, not normal to the common activity, operating business activities of this company. So the earnings attributable to shareholders after the extraordinary activities or items, in this case, is 5 million. Okay, so we have all the necessary information to start with at least the numerator of the formula. The next thing we need to decide is the weighted average number of shares outstanding. So how much shares we have had in issue during this year. Remember that we start with 3 million shares, and they are in issue for 8 months out of 12 before we issue 400,000 new shares, and that means that for the rest of 4 months for this year, we have in issue 3,400,000 shares. They are outstanding or in issue for 4 months out of a year. So again, if we make the calculations, 3 million multiplied by 8, I'm just following some formulas. So for you, if you try to use the same Excel files, that can be helpful. So the total here gives us the amount of the outstanding weighted average shares. That is 3 million and so. Sorry about that. Okay, October, November, and December, right? So, okay, that is a mistake from me. I was really hoping that you would understand before I would continue. Are you still there with me or not? Or are you sleeping a little bit? Okay, Valentina, thank you for reacting. Right now, my apologies for the mistake. The common stock was issued in 1st of October. That means that these 400,000 new shares are outstanding for only 3 months, October, November, and December. whereas the 3 millions are outstanding for 9 months. So the calculations should be changed over here. I reflected that. I made sure it was okay. So we can calculate the number of weighted average shares, 3,100,000. Now we are ready to calculate and report the two basic earnings per share figure we are required. Again, in the first part, we take into account different levels of the results of the earnings. And in the second part, we take into account different levels of a number. We calculate the number of shares. Right now, we need to disclose two figures. Basic earnings per share before the extraordinary items and basic earnings per share after the extraordinary items. Now, basically, they are the same thing. The only difference is the line of profit or a line of earnings where we base our calculations. The basic earnings per share before the extraordinary items would be based on the earnings attributable to common shareholders before extraordinary items divided by the number of weighted average shares over here. So basically the formula would be the same, only the line where we base our calculation would differ. In basic earnings per share after extraordinary items, we focus to the earnings after taking into account the extraordinary items and divide them to the weighted average number of shares. So we receive another amount of the basic earnings per share, of course, obviously, because both of them reflect different results or different profit of the company. I guess that was it. We are not required to do anything else in this exercise. Please correct me if I am wrong. Now, I'm putting in brackets only what we did to base our calculations, in case you were wondering how we did that when you read this exercise later. So I'm putting the correct amounts and the calculations over here, in case you read again this exercise before the exam. Any questions so far? Should we continue with discussing the same exercise? Or that is clear and we can continue with problem 5. Remember, we still have two problems regarding the earnings per share, and then we will explain something that relates to the segment reporting. I'm waiting just for a minute in case you have any questions. Okay, apparently not. So we will continue with problem 5 right now. That's a little bit, it's not complicated, but it has some more information that we need to read carefully, and afterwards we can proceed with making all the necessary explanation. Actually, I think this is an example or an exercise from the book, from the textbook, if I'm not wrong. So we have this listed company. The extract from financial statements that end on 31st of August. Now you have the case of a company whose accounting year is not the same as the calendar year. As we discussed today during the lecture, there are some jurisdictions that require the accounting year to be different than the calendar year, and this is an example that we have here. The amounts are shown in millions and belong to two consecutive years, 2017 and 2018. What we basically have over there is the profit before taxes and the income tax expense for both years. Then we have the profit for the period, which basically is the difference between profit before taxes and the income tax expenses. There are also some other pieces of information very useful to go through. At the beginning of this year, of the first year, 2017, which is 1st of September, always, the company had 750,000 million ordinary shares in issue. This is like the beginning of the period. The market price was clearly above the par value. The par value or the face value of the ordinary shares is 50 cents, whereas the market price is 87.6 cents, and that's a normal condition. Usually all the companies that are quoted in the stock market, usually they will have a market price above or bigger, larger than the par value. Then what happens is that on 1st of December, let's count the months. From 1st of September to 1st of December, that means 3 months, okay? Remember this because we may make mistake again. We had a bonus issue, okay? So remember how we treat the bonus issue. The bonus issue represented one new ordinary share, let's write it like this, for every 3 held. Okay, if we write in numbers, probably it's easier, at least for me. Numbers are easier to understand than words. So again, we have made a bonus issue, one new share for every 3 that we are holding. Okay, then in 2006, the company had issued, so previous to these 2 years, in the past, 75 million euro convertible bonds. Okay, in 4 years, that is in 2020, each unit of 100 euro of bonds will be converted at the holder's option into 200 ordinary 50-cent shares. But this is what is important for us. That means that the value of the convertible bonds is 75 million, but each unit of 100 euro can be converted to 200 shares. And that's fair because the face value, the par value of one share is 50 cents. And that means that if I have a loan of 100 euro, I will take back, I will convert that to an amount of 200 shares. Okay. Then we also have this information. The interest expenses related to the liability element of the bonds, that is all important information, and I'm putting that in italics letters. The interest expenditure related to this bond, which is convertible, for both years was respectively 6.3 million and 6.2 million euro. And also the tax effect that is related to this interest expenditure was 2 million euro in 2018 and 1.8 million euro in 2017. Okay, now we are used with, or we are familiarized with the data, what it is required over here. Calculate earnings per share and diluted earnings per share for your 2018, including the comparative figures. That means that comparative figures are 2017. They are also to be included there. And then we are to explain any reason for the treatment of the bonus shares as required by IAS 33. What does that mean? We know that the bonus treatment should be treated retrospectively. That means that we should take back the effects of bonus issue into the past as far as we can. That is the earliest period reported by the entity. Now, if the entity is preparing financial statements of 2018, following the requirements of IFRS, it should present comparable information of the previous year. So you should always present information for 2 years in financial statements, okay? So first of all, if we are having a situation with bonus issue, remember that each time we have a bonus issue, we have to calculate a bonus factor, or as the chapter recognizes that, a bonus fraction. Remember how we can calculate the bonus factor. It is simply, at least it is simpler than in the case of rights issue. The bonus factor is the ratio between the number of shares. that is shares after the bonus issue to the number of shares prior or before the bonus issue. Now that would be very easy to calculate. Just have a look at the bonus over here that we are mentioned. The bonus is 1 for every 3. How? That means that before the issue of the bonus we have 3 common shares, and after the issue of the bonus we will have 1 more, that is 4 to 3. So the bonus factor is equal to 4 to 3. Be careful, we also need the inverse of bonus factor that will have a certain use later. We will mention that. And the inverse of bonus factor is the inverse ratio, that is 3 to 4. Okay? Any question on how the bonus factor was calculated? Okay. I'm adding some information over here. Bonus issue of shares is equal to, we previously have 750,000 million of shares multiplied by 4 divided by 3, which is the bonus factor over here. And right now we have 1 billion new shares. So the new number of shares after the bonus issue is 1,000 million or 1 billion. Okay? Okay, so we can start with the calculation of the basic earnings per share and diluted earnings per share, but I will mention that we will do the calculation for both years, 2018 and 2017 over here. So we start with the first figure, which is the net income of the year. Respectively, the net income for 2018 was 191.4, whereas for the previous year it was 182.7. Again, this is readily available information that we have here. So profit for the period, or net income, is the amount that we should take into account for calculating basic earnings per share. Do we have any preferred shares over here? We read very carefully the information. We have bonus issue and we have some convertible bonds. So this is a problem that combines together bonus issue and diluted earnings per share, but no preferred shares in there. So as far as I do not have preferred shares, this net income is available to common shareholders. I can be sure that I can use this amount of net income to properly calculate the amount of the basic earnings per share. The next item that I need to calculate is the weighted average number of shares outstanding. Okay, so remember what we do in the case of bonus issue according to the requirements of IAS 33. Remember that we should take into account the bonus issue as it is issued at the earliest period available. That means that if we start with 750 million shares, these are million shares over here, we have to calculate that by the amount of time they are outstanding, that is 3 months out of 12, but also with the bonus fraction 4 to 3. Again, why do we do that? According to the requirements of IAS 33. That means that we are assuming that this starting amount of shares that does not include the bonus issue is taking into account the bonus factor, is multiplied by that to reflect the increase in the number of shares. So we start with 750,000 million shares. that we multiplied by the time period 3 to 12 and also by the bonus factor over here. So what we will have 750 multiplied by 3 to 12 and then multiplied by 4 to 3. Here we have 250,000. All the data in this table is represented in millions, okay? Then to calculate the weighted average number of shares outstanding, of course we need to take into account the rest of the year. For the rest of the year we have 1,000 million shares and they have been outstanding or in issue for 9 out of 12 months. No need to take into account any bonus factor over there, okay? Because this amount of shares, this new number 100,000 or 1,000 million, it includes the bonus issue. What we need to adjust with the bonus factor is only the opening balance or the opening number of shares. So right here we will have an amount of, okay, let's make them with the formula in order to not make mistakes. 750,000, good. So the weighted average number of shares is 250 plus 750. Now, some of you may think that we really had the long road to make all these calculations, and we find out that the weighted average is 1 million, 1,000 million or 1 billion over here, the same as is after the bonus issue. So if the IAS 33 requires us to consider the bonus issue since from the earliest period presented, and in 2018 that means since from 1st of January, it is simply 1 million. No need to make all these calculations to come up with this figure over here, which is simply the closing balance of the shares. So number of shares after the bonus, number of shares after the bonus issue. This is why I wrote that over there. So actually what we do when we take into account the bonus factor is that for the current year, when the bonus is issued, actually the weighted average number of shares will be the same number of shares as at the end of the period after the bonus issue. 1,000 million over here or 1 billion shares. Why do we do all these calculations? Oh, well, they are needed according to the requirements of IAS 33. But to have a shortcut, remember, the weighted average is the same as number of shares after issuing the bonus. Okay, we finished the basic earning per share for 2018 and then we have a short break. So after we calculate both components, we are ready to calculate basic earnings per share. Let's start with the ratio between net income and the weighted average number of shares over here. Okay, so the basic earnings per share is 19 cents point 14, or I'm just reducing the amount a little bit. Okay, this is the solution for the first year for the basic earning per share only. Just a short break and we come to continue with the second year. Okay, I hope you are ready to complete the last hour for today, as it is the last hour of exercises that divides us from the weekend to be started. It's a long weekend, so maybe we can just finish that quickly. So of course we are trying to cover two things in one problem, that is issuing a bonus as well as having to deal with a dilutive security, such as a loan convertible a little bit later. But first of all, let's start with basic earnings per share and considering the basic earning per share into 2 years, the current year and also restating the figures from the previous year. Now, at 2017, we might add another column and to say 2017 as reported, and then we would have 2017 restated. Sometimes you will find the same columns in real financial statements when the companies have actually restated their amounts. They will usually report what they did in the previous year and what actually they restated in the current year. So let's start with what has been reported 1 year ago. Okay, so this is 2017 as reported. They have reported net income, which does not change, and the weighted average number of shares outstanding in 2017 actually was 700,000 million shares. So in millions, that would be just 750,000. So this is the number of shares that we have in the previous year. No bonus issue during the previous year, so no changes in the number of shares. That means that the basic earnings per share 1 year ago would be the ratio between net income back in that year to the weighted average number of shares, which is 0.24, or that means 24.36 cents. If I come to the restated 2017, if you remember, the restated amount of basic earnings per share is simply the previously reported basic earnings per share multiplied by the inverse of bonus fraction or bonus factor. That means that the basic earnings per share restated in 2017 would simply be the previously reported amount multiplied by the inverse, which is 3 to 4, so multiplied by 3 and divided by 4. This would be the restated basic earnings per share, okay? So for the moment, let's pass that figure over here and let's assume another way of trying to calculate the basic earning per share for 2017. Another way, not a shortcut like this is a shortcut that we are mentioning here, but another way to treat the situation is to have the net income for 2017, which basically is 182.7, and to regard as the weighted average number of shares outstanding, not 750. This is the amount that I declared by end of 2017 when I didn't know that I would issue a bonus in 2018. Now that I know that, I'm right now, this is the moment at the end of 2018, and I know that I issued the bonus, and I know that IAS 33 requires me to take this back at the earliest period reported. That means to take the new number of bonus shares after issuing the bonus 1,000 million, to take it back since the beginning of the first period. So the restated number of shares in 2017 would be 1 million. That means that the basic earnings per share for 2017 restated would be the net income divided by the adjusted weighted average number of shares to reflect the bonus issue. We would have, as you can see over here, the same amount I will go to the chart right now. You see that we have the same amount of basic earning per share. So a shortcut is to just calculate the basic earning per share for 2017 as it was reported in that year when I didn't know that the bonus would be issued. Then I I could use that to multiply with the inverse of bonus fraction. In this case, 24.36 multiplied by 3 to 4. That would give me a result of 18.27. Okay, that would be the result. I think I have a question in the chat. Yes. Okay, the year 2017. That's a good question. That's a good question. That's a good and a funny question, because we mentioned that this is the case of a company in which the financial statements are ending on the August of 2018. That means if I say beginning of 2018, actually it's 1st of September 2017. Okay, so it's a way of expressing that the 2018 accounting year is not the same as the calendar year, okay? Because you see here, the financial period are ending on 31st of August of 2018, or 80 in this case. That means that when I prepare the financial statements in 31st of August 2017, the bonus issue will happen in 1st of December of that year. I prepare the financial statements in August, and then I issue the bonus 3 months after that. That means that I will declare or report a basic earning per share without considering the bonus that is issued later. Again, this 1st of December 2017, you see, is part of 2018 accounting year. Okay, does that make sense now? I know that this kind of problems when the accounting years are not the same as the calendar years are not really very comfortable to deal with, but please consider that this is why the year does not correspond to the calendar year. So again, by the end of 2017, that means 31st of August 2017, we don't know anything about the bonus issue yet. I am again showing the solution to you. Again, think. The previously reported figure is as if we have not issued the bonus. But when we restate the figures at the end of 2018, we may calculate the restated basic earning per share into 2 ways. The shortcut is to apply the inverse of bonus fraction. And this is what I advise to you. Take the shortcut and you will make no mistake. The long way, the companies that usually follow are the companies that report very detailed information. You've seen financial statements hundreds of pages long, so they obviously have this information there. What they usually do is that they start for the previous year to restate the amount. They start with the earnings and they restate the weighted average number of shares by multiplying the denominator of the ratio with the bonus fraction. Mathematically is the same as the action we are doing over here, to multiply the earnings per share itself with the inverse of the bonus section. Okay, so this is what we need to know about the calculation of basic earning per share in 2 years, current year and restating the previous year. But we also have to say something about the diluted earnings per share. Now, if you can see here, we had previously, before 2017, we had issued some convertible bonds. And in 4 years, that means that might happen in the future, but the standard requires us to assume that if all the bondholders will make the conversion. So what the standard basically assumes is that we are not having a partial conversion of only half of the bonds, but of all of them. And we will assume like it is happening now in 2018. So let's go to the solution page and let's start with our endeavors to try to calculate the diluted earnings per share. Now I'm just putting 2 years over there, 2018. and 2017 over here. So to calculate the diluted earnings per share, we normally will start with the amount of earnings. We start with the amount of earnings, but be careful that having to deal with some convertible bonds, we have to adjust the earnings to reflect for the savings for not having to pay some interest. So we say here earnings plus after or post-tax effect of interest expenses. Okay, so let's take into consideration both elements over here. The earnings are the same as in the previous calculations of the basic earnings per share. So accordingly, for every year, it is this sum over here. Now, after tax effect of interest expenditure. Now we have to show the data that we said it is all important over here. You see the interest expenses related to the liability element. The interest expense for 2018 is 6.3. The tax effect related is 2, whereas for the previous year, you can see it's 6.2. The tax effect is 1.8 million. That means that the formula that we know, interest expenses, which is multiplied by 1 less percentage of taxes, is even more easy to apply over here, because we know that the interest expense is 6.3 million in the current year, and the tax effect is 2 million. That means that over here I will have 4.3 million after tax effect. Whereas in 2017, if I am not wrong, it was 6.2 million, less the tax effect was 1.8. So what we'll have here, 6.2 less 1.8, the after tax effect is 4.4. Again, have a look at the data, information over here. It is, in a certain way, it's easier than usual because it is not given the tax with the tax rate and I need to calculate to the formula, but it is simply represented there that the interest expenses is 6.3, whereas the tax savings is 2. That is that after tax effect of interest expenses is the difference, 4.3. So we have the adjusted earnings that I should use in calculating the diluted earnings per share, or the diluted earnings. That is the earnings plus the after tax effect. We would have normally a higher amount of earnings over here to use in our calculations. Okay, any questions so far? Do I need to explain anything else? Calculating diluted earnings per share, we are starting with the adjusted earnings to reflect the convertible securities. We do not have any more loans. We do not need to pay taxes anymore. And the information provided is very specific. This is the interest expenses. This is the tax saving for each year. By combining both of them, we receive the after-tax effect of interest expenses over here. So the next thing that we need to do is to calculate the next item or component to include in diluted earnings per share. That is the weighted average number of shares over here. So we start with, in 2018, there are several things to consider. As we said, we start with 750,000 million of shares. We multiply them by the number of months they have been outstanding. Remember that there were 3 months, and then we multiply that by the bonus fraction 4 to 3. Then we have issued some other shares. That means that the new number of shares is 100 million, and they are outstanding for the rest of the period, that is 9 to 12 months. The other component that I need to take into account to calculate the full weighted average number of shares is convertible bonds to shares, to common shares. So we calculated a little bit earlier each of these figures, so I'm not repeating the calculation. This is 250. The next one is 750. Now, I should take some minutes only to calculate the number of convertible bonds to shares. Now, you read carefully what is this over here. 75 million, each unit of 100 euro is converted to 200 ordinary share. That means that will be equal to 75 million divided by 100 euros and multiply by 200 common shares. The number of shares that we would get, I guess, is 150. So the total of all these items over here will give us the weighted average number of shares adjusted to be used in the calculations of diluted earnings per share. So diluted earnings per share basically is the ratio between the adjusted earnings, the adjusted number of shares to reflect the bonus issue and the dilutive security, so both elements. That's why we have three items over here, unlike the other cases. Okay, so the diluted earnings per share for 2018 is 17 cents per share. What we do for the previous year? Well, either way, either I will take the adjusted earnings and I will restate the amount of the weighted average number of shares and will calculate the restated amount, like the division of both, or the shortcut, as we call that. The shortcut is the short way that we take. The shortcut is calculate or find the basic earning per share as declared in the end, and in the end we mean 31st of August 2017, and multiply that with the inverse of the bonus factor. Okay, so this is the second way. In this case, this is not the shortcut for us. Why? Because we do not have the diluted earnings per share in 2017 to take that and to restate by multiplying. It's easier for us in this case to follow the first method, that is to restate the weighted average number of shares by taking into account the two factors, the bonus issue, I apologize, and the dilutive security. Something else that I wanted to mention, and you should be very careful about this. Diluted earnings per share is only restated when you have issued bonus or rights. That means that if in 2018 there is no bonus issue, you are not required to restate diluted earnings per share over here. Okay, so diluted earnings per share is only restated in case you have issued bonus or rights in the current years. If I'm not wrong, this is something paragraph 65 of the standard. That is, you only restate and adjust the amount of diluted earnings per share only in those cases when you have issued bonus or rights in the current period. Any question to that? Anyone that tried to solve this exercise and found the same solution? Anything you want to ask? Please? Okay, I can see that you are attentive, but you are not having any question. That means that probably, hopefully, you are understanding everything. Okay, so right now we can jump to the last problems that we are having for today. That is problem 6 of tutorial 3. Okay, Adela is asking, shouldn't convertible bonds do not considered in 2017? No. In 2017, of course, I consider convertible bonds because they have been issued in 2016. So in 2017, when I'm not in 2018, okay, I'm by the end of 2017. I included convertible bonds in calculation of the diluted earnings per share, okay, back in 2017. But when I come in 2018 and I issue bonus, that would affect both basic earnings per share and diluted earnings per share of the previous year, okay? This is what I'm saying. That means that for 2017, of course, you'd have calculated and declared the diluted earnings per share that would have taken into account the amount of the convertible bonds, okay? But right now, what we are saying is that we take into account also the bonus issue, okay? So this is what we are trying to say. Thank you for your question. So let's jump to the last exercise, and then we'll have time for the segment reporting example, and then we are done for today. This is again an exercise in the textbook that you are working with. Actually, it is exercise 14 in chapter 24. 24 is the chapter relating or covering the earnings per share. We have over here some extracts from the financial statements of this company for the year that ends in March 31st. So again, we have the example of a company whose accounting year does not fit with or is not compatible with the calendaric year. This company starts its activity in 1st of April and completes the accounting activities in March 31st of each of the years. We have some data from statement of profit and loss and other comprehensive income, and they are declared into two different panels, let's say, continuing and discontinuing. Now remember that IAS 33 requires both basic and diluted earnings per share to be calculated separately and disclosed separately for continuing and for discontinuing operations. For both these kind of activities, we have profit before taxes, we have the tax expenses or the tax relief if it is an income, in the case that the government may reimburse, may refund these expenses, and in this case it is considered a tax relief, not a tax charge. It's not an expense for the company. It's a refund they are getting back from the government. It's a reimbursement. That is a relief. And then we have profit from the ordinary activities over here. We have some information about the financial position. We have 500,000 euro, which are 6% non-redeemable. Preference shares, you see, they are preference shares and non-redeemable. That means that they are not going to be paid back. They are not going to be redeemed, okay? The next item is an amount of convertible. You see here the key word is convertible preference shares, €1 each. And then the last item is non-current liabilities, which is loan stock, and we have some information over there. At the beginning of the current accounting period, there were 7 million outstanding common shares, and 800,000 other common shares were issued in September 30 of the current year. Now that we are here, we may count the months in order to not be distracted later. We start in 1st of April, so it's April, May, June, July, August, so in September. That means after 6 months. So again, from the beginning of the year, which starts in 1st of April, until 30th of September, that means that 6 months have passed, or 6 months have been this amount in issue, okay? The 10% convertible preference shares are to be converted on a basis of 3 ordinary shares for every 5 preference shares. Okay, this is the terms of conversion for these convertible preference shares over here. This should happen on 31st of March 2005, okay, after 2 years, at the option of the preference shareholder. That means that this may happen later, but we will account for that starting from this period. Whereas the 8% convertible bonds, over here, the last item, is redeemable or can be converted. You can see here, it can be converted to ordinary shares on the basis of 120 ordinary shares for each 100 euro loan stock at the holder's option. There are also in issue directors' share options. So there are these options for 4 million ordinary share. They were issued before in 2012 and are exercisable in a future period at a price which you see is obviously lower than the market price. Market price is 2 euro, whereas the exercising price of the options is 1.4 euro per share. We also have the income tax rate, 25%, and we are required to calculate the earnings per share for this year that ends 31st of March 2003, and also to calculate the effect of earnings for each dilutive security. Now, actually, we have 3 kinds of dilutive securities over here, so we have some calculations to do about them. But first, let's start with calculating the earnings per share over here. So first of all, calculations regarding the basic earning per share. So this is what we need to start with. Let's assume that we start with profit before interest and taxes. Okay, so this is the profit before interest and taxes, and then we deduct the preferred dividend. Remember that we have two classes of preferred shares, if I'm not wrong. The profit before interest and taxes we can take from the data over here, the total profit from the ordinary activities. That is my mistake and lapsus, sorry about that. So profit from the ordinary activities in total, not yet dividing, continuing and discontinuing operations, is 1,030. These are in millions. We have to deduct less here the preferred dividend. Now remember that the dividend is related to 2 different classes. We have 500,000 at a 6% dividend, and then we have 1 million at a 10% dividend. So when we calculate the dividend, we would make this kind of computations over here. 500,000 multiplied by 6% plus 1 million that are applying a 10% dividend rate. So this is the calculation related to the preferred dividend over here. Okay, so 530, 130. Okay, so this is the preferred dividends we are talking about. That means that the profit attributable to the common shareholders is actually the difference between profit from the ordinary activities less the calculated amount of preferred dividend. Any questions so far? So simply we are calculating what is the amount of profit attributable to the common shareholders, and this is actually the numerator of the formula for basic earnings per share. Now we have to calculate the weighted average number of shares outstanding during this period. This is the next item we need to calculate. So we start with 7 million in thousands over here that are in circulation for 9 months out of 12 plus 708,000. Okay, sorry. I mentioned that I would be really very careful with the months. 7 million are in circulation for 6 months only. 708,000 are in circulation for the rest of the year. Okay, so again, this is one way to perform the calculations. Let's have a look over here, please, and remind ourselves what we are talking about. At the beginning of the current period, there were 7 million. Okay, so we start with 7 million, and in September 30, we issue 800,000 other common shares. Now we counted the months. September 30, if the financial year is ending on March 31st, September 30 belongs 6 months after that. So this is how we perform the calculations over here. So basically this is equal to 7,000 multiplied by 6 divided by 12 plus 7,800 again multiplied by 6 and divided by 12. This is the weighted average number of shares we should take into account. This is one way of making the calculations, dear students. You know the other way, the other approach, you can follow either of them, it's the same thing. The other approach assumes that the initial amount of shares is issued or outstanding for the whole year, so multiplied by 12 months out of 12, plus the new number of shares, 800,000, they are considered to be around only for 6 months. Whatever is the way that you follow to perform your calculations, supposedly you are going to have the same result over here. So the basic earnings per share that you are going to account is 900 divided by 7,400 over here. If we express that in cents, that would be 12. Okay, so 12.17 cents per share. So this is the calculation of the basic earnings per share. Any questions so far? Simply a repetition of what we have constantly said and explained so far. The next requirement is to show the effects of dilutive security. And in this table over here, I will summarize the effects of the dilutive securities that this company has actually outstanding now, which are one by one the dilutive securities of this company. The first one, it is the number one here, is the options. You remember that we had some options that are exercisable at a price, exercising price, which is below the price of the market. Okay, the second dilutive security is going to be the 10% convertible shares, preferred shares. Remember, we have two classes of preferred shares, but not all of them are convertible, only the 10% are convertible. And the third dilutive security, don't forget the 8% convertible loan stock. So these are the classes of dilutive securities, and we show that in the first column of our table, where we will show the effects that this dilutive security will have on the earnings. Okay, so first of all, we show what is the increase in number of shares attributed or due to the exercise of these dilutive securities specifically. So the increase in number of shares for each of the dilutive securities. Then we will show the increase in earnings, the next column. And by dividing the two first columns, let's say that increase in number of shares is column A, and increase in earnings, let's assume, is column be the column C, actually, it will be the incremental or increase earnings per share. And incremental earnings per share will normally be the ratio between column B and column A over here. Okay, so let us start and try to put all the facts in this table with recognizing all the effects of different items. How much the options will be. Now, let's have some data about the options over here. Let's refer to the primary information. Okay. Share options for 4 million. Okay, they are issued, they are exercisable on 31st of March 2005 at a price of 1.4 per share, whereas the market price, remember, is 2 euro for each share. Now, what we assume for options, I will put a sign and I will explain it over here. IAS 33 requires to consider the proceedings from option exercise as funds used to purchase shares at the market price. Now, this is a very, I would say that this is like a simple explanation of what happens with the options. We had a specific example during our lecture, and afterwards I had several of you asking question, why is that considered like that? Why do we consider it inferred shares, if you remember, and so. Actually, what IAS 33 says is that we issue the options and we assume that these options are exercised in full. And the money that we take back from exercising the options will be used to repurchase share at the market price. And only the difference will be considered as bonus amount of shares. So from exercising actually options, we receive how much money? From exercising the options, remember we have 4 million, price 1.4. So we receive 4 million multiplied by 1.4. How much money do we receive? I think we receive 5.6. Please correct if I'm wrong. $5.6 million in this case, okay? So this money is used to repurchase some of these newly converted shares from the market at the market price. Why is that so? Because the company does not want to have too many shares in the market because it would make her share price go lower, and this is something that the companies do not really prefer. And that is why usually when the options are exercised, the company will go back in the market and purchase back some of these shares at market price and treat them as treasury shares. So how many shares can we buy back with $5.6 million? Okay, market share price is 2. Okay, so that is we buy back point. We buy back 2.8 million. We buy back 2.8 million shares. Remember that these are known as inferred shares by the IAS 33 standard, okay? So these inferred shares are shares that we buy back in order to reverse them. Therefore, we can say here, the free, if we assume them to be free, the free number of shares that really increase in the number of outstanding shares is equal to 4 million were issued from the option exercising less 2.800 to 1,800,000. That is 1,200,000 new shares. I spent several minutes to be very detailed about how we calculate the amount of the shares that are dilutive in the case of options. Okay, so for something that we spent very few time the first lecture, I try to explain in detail now. So what S33 requires is that we convert the options into shares, and that money we use to buy back from the market some existing shares with the price market, and the difference, the free number of shares, is what is left, and this is important to know. So the free number of shares that really increased in the number of outstanding shares is 102 million. That is shares that remained outstanding in the market. Please let me know if this is not clear yet for some of you. So the increase in the number of shares right here at the table that we prepared is 1,200,000. Do we have a change in the earnings right here? We do not have a change, so not applicable, and therefore we cannot calculate any incremental earnings per share. What can we say about the 10% convertible preferred shares? Now you see here these 10%, okay, are to be converted, remember, on a basis of 3 ordinary shares for every 5 preferred shares. Good. Now these are 1 million over here, and that means that these shares, which are 1 million or 1,000, will be converted over. I'm trying to put the calculations correctly so you know what to expect when you see the exercise. So it is 1,000 divided by 5, and each of them will be converted in 3 new shares. So these 1,000 preferred shares with 10% interest will be converted into 600,000 always of new shares that we are having represented here. What is the increase in earnings? Actually, the increase in earnings, remember, I'm putting a note over here so you can see. Remember that preferred dividend is already after taxes. So there is no tax regulation or tax effect that you should keep in mind over there. That means that if you have 1,000 preferred shares and it is applying a 10% dividend, that means that the dividend or increase in earnings is going to be 100. So what is the incremental earnings per share? As I said, column B divided by column A, that is like the formula of earnings per share, right? Earnings to number of shares, and we would have an incremental earnings per share 17 cents per share, or otherwise, if we use the format over here, it is 17.6 cents per share. Okay? Any questions so far? I need to have another explanation over here about the 8% convertible bonds. Now, what can we say is that the number of shares issued on conversion on this diluted security, number of shares issued on conversion would be 1,800,000. And that is shown in brackets, like we have a loan with the value 1 1,500,000, and that we said each 100 euro of that will be converted in 120 shares. That is that the number of new shares will be 1,800,000, whereas the savings from the interest expenses of this loan would be net of taxes. Always we show them here. Of course, we have 1,500,000 loan multiplied with an 8% interest. That means that we have $120,000 interest expenses, which is adjusted for after tax effects right here. So this is 120,000 multiplied by 1 less percentage of taxation, and the taxes were 25%, that is multiplied by 75%, that would be, allow me to make the calculations over here, that would be $90,000. So this is the incremental earning and the incremental number of shares according to the convertible loan stock. Okay, so let's have the calculation what the incremental earning per share would be. In this case, it would be only 5 cents. Okay, so the most dilutive security is the convertible loan stock. It lowers the amount of the earnings per share. Okay, any question to clarify this exercise? Any question you need to ask? I know that you are tired. It has been a long day, and I hope that at least you understood what we are doing, what we are trying to do over here. We are not calculating diluted earnings per share, right? We are calculating how much the earnings per share would change only if we apply only one of the classes of dilutive securities. Be careful, this exercise has 3 different dilutive securities, so I should take those into consideration one by one. What is a little bit more complicated to understand is clarified here, so you have the asterisks to really guide you through understanding the solution, whereas for the preferred shares it's pretty easy to consider, so I just put the information in the form of the comment. Any questions so far? Okay. Sophia, right? So I guess Sophia is asking about the first requirement over here, right? Oh, okay. Am I right, Sophia? Is this the point that you are asking about? This is, like we said, we have 2 different ways to calculate the weighted average number of shares, okay? Now, the first one, the one that it's clear for you, is when we consider the specific period of times with the correct total amount of shares that they are outstanding. So we know that for the first 6 months we have only 7 million, and for the other 6 months we have 7,800,000. So this is understandable for you. But another way to look at the situation is to focus not on the number of shares for the specific time, but to focus on how long these shares have been outstanding. So I would say, for example, I start with 7 million, and these 7 millions have been outstanding from the beginning to the end of the year. So they are outstanding for 12 months out of 12, right? So the opening number of shares of 7 million are still there by the end of the year. So they are outstanding for the whole year round. Whereas the 800,000 shares that I issued on 30th of September, they are outstanding only for the 6 months. They were issued in September and until the end of the year. That means that they are 6 months outstanding. Remember that for this company, the end of the year is 31st of March of the next calendar year, okay? So this is why they are outstanding for 6 months only. Yes, I know, Vittoria. I know that in the PDF you don't have the data for 7 million shares, but if you refer, as I already mentioned, if you refer to the full exercise in the textbook, it is pretty detailed over there. It is very long. I only inserted the most important information over here. Okay, so always you can have a look at the exercise in the textbook. Okay? Okay. Maybe it is some data missing. Okay, I apologize for that. We will correct. When we upload the Excel file right now, you will have the complete information. Any other question related to what we covered as the last question? Any other question, please? Okay. Maybe this means that we do not have any more question. Can you see my Excel file right now? Okay. So have a look at the information that you have here. I promise it will take us only 2 minutes, okay? So as I said, we are not going to take a long time because I know that maybe we are by the end right now of our day, so you are tired and so on. And probably this may also not be of interest to many of you. But I saw that someone asked in the previous hour, one of you asked about how to include more segments in case we do not comply with the 70% threshold requirement for reporting different segments. Therefore, I have an example over here of a company that has 6 different segments. And you can see that we have the segment revenue from external sales. For each of them, we have intersegmental revenue, profit or loss for the segment, and also the segment assets. What we also have here is information about the identification or information about the activity of each of the segments. It is included here, and we proceed by recognizing the thresholds. So one of the 3 is enough. Segment revenue higher than 10% of total revenue. Now remember that what we report in here is external and intersegmental revenue, both of them, the sum of both of them is total revenue, okay? So the next threshold is the result, and the other one is the segment assets. When we identify the reportable segments, we see that only the 3 first segments are reportable. The electronic segment, finance and service is not reportable. So that means that the next step is to check if we comply with the 70% threshold. It is 325 because it really relates to the total segment revenue only. And that means that the threshold we are looking to comply with is 243.70.75, okay? So we continue to check. The total external revenue of the 3 reportable segments actually is lower than this threshold. And in this case, we continue to identify reportable segments until the 75% threshold is met. For example, we may include as the reportable segment the finance segment that has the largest external revenue among them. For example, the finance segment over here among the non-reported segments, this one has the largest amount for external revenue. If we include this new segment, that makes the total external revenue of the reportable segments 252, and that is more than the threshold. That is more than 70% of 325. That is more than the threshold, 143.75 million of dollars. Okay, so this is what I had prepared about the segment treatment. I will pause this exercise as well in Moodle, and I think it's easy, but in case you need to ask something about the reportable segments, you can ask in the future sessions. Now we have the weekend, a long weekend before us, and we will see each other on Wednesday next week in class, where we will continue the lecture and also the afternoon sessions. Remember that in the next week we will have afternoon session tutorial on Wednesday and Friday, but Friday will be more for presenting. And remember that we will have tutorial or class hours also on Monday in the week of the exam. Yes, the previous exercise, Gloria, it is required to calculate the basic earnings per share separately